Aloha! It's Friday, and here we are talking real estate again. Our usual thing to do on Friday. Well, this is Jamie Barber with Jamie Barber Homes saying Aloha, Friday. Aloha, it's Friday. So let's get right down to it. We're going to discuss a little real estate. Well, mainly we're going to discuss mortgage rates. But let's start with, again, we've got no inventory in the market. So if you want to sell, it's a good time to sell. There's not a lot out there. So you can ask top dollar for that house. And if you want to buy, interest rates are still low, but they are going up. So this is a good time to buy. So let's discuss interest rates, or mortgage rates, actually. So mortgage rates topped 4% this week for the first time in nearly 3 years and are expected to keep climbing. The rate on 30-year fixed rate mortgages averaged 4.16% for the week through March 17th, which is this week. The first time it exceeded 4% since May 2019. Now, that's according to Freddie Mac. And that was up from 3.85% a week earlier and 3.09% a year ago. Now, if you don't know, Freddie Mac is the Federal Home Loan Mortgage Corporation. It buys mortgages, pools them, sells them as mortgage-backed securities to private investors on the open market. This secondary mortgage market increases the supply of money available for mortgage lending and increases the money available for new home purchases. So Freddie keeps an eye on what the interest rates are. So the rates have been ticking up thanks to a 40-year high inflation, which the Federal Reserve is attempting to rein in by raising interest rates. On Wednesday, the Fed raised its benchmark rate by 0.25 percentage point, the first hike since 2018, and it signaled that 6 more similarly sized increases were on the way. Now, mortgages don't move in lockstep with the Fed benchmark. They instead track the yield on 10-year Treasury bonds. That figure is influenced by a variety of factors, including the inflation rate, the Fed's actions, and how investors react to them. Now, the Federal Reserve raising short-term rates and signaling further increases means mortgage rates should continue to rise over the course of the year. Now, that was said by Sam Catter. That's Freddie Mac's chief economist. Now, he also said, while home purchase demand has moderated, it remains competitive due to low existing inventory, like I told you at the start, suggesting high house price pressures will continue until the spring home buying season. The average rate on a 30-year fixed mortgage dropped as low as 2.65% in January of 2021. Now, that's over. 2.65% ain't happening now. We're on our way up. Now, by rising the federal funds rate, that's the rate that banks charge one another for overnight loans. The Fed sets off a ripple effect. Whether directly or indirectly, a number of borrowing costs for consumers are going to go up. Now, let's look at some of those. Let's look at your consumer loans. Changes in credit card rates will closely track the Fed's moves, so you guys can expect to pay more on your revolving debt. That's your credit cards and any of your other, anything else that you've got on a revolving card. So it could be, your Macy's card, all of it, your gas card, and private student loan borrowers should expect to pay more. And car loans tend to track the 5-year Treasury, which is influenced by the federal fund rate. So rates for vehicles are expected to rise too. If you can get a vehicle, there's still a chip shortage. Oh my gosh. It's horrible out there. And if you're trying to get a car now, the prices were going up anyway because there was not enough cars. And now they're going to raise the interest rates on the loan if you could get a car. Now, an increase in the Fed benchmark often means banks will pay more interest on their deposits, which is a good sign. But large banks are less likely to pay consumers more, though. Online banks have already started raising some of their rates. So it's good if you're into online banking. Wednesday's hike was projected to be the first in a series of increases, and experts say consumers probably won't feel the pinch until more of them roll out. The pain to the consumer from accumulated hikes probably doesn't start to bite until several rate increases are in place. That was a quote from Keith Gumbinger, the vice president HSH.com, and they track the mortgage market. Well, so that's it. Just letting you give you an idea of what happened with the Fed on Wednesday. So mortgages are going to go up. Credit card rates are going to go up. They're trying to rein in inflation. So it's a good time. If you've got a house, it's a good time to sell. And if you want to buy a house, it's a good time to buy before the interest rates start even rising more. All right. Well, you can get a hold of me, Jamie at jamiebarberhomes.com, and we can discuss this further, whether you want to sell, whether you want to buy, or whether you just want to discuss real estate. Well, that's it. That's Aloha Friday, our little discussion on mortgages and what the Fed is doing in the raising of their rates. So it's Aloha Friday. No work till Monday, unless you're a realtor or you're in retail sales. Well, you guys have a great weekend. And aloha, it's Friday. Enjoy the weekend. And if you need to, get a hold of me. We can sell your house or we can buy one before the interest rates get too high. Have a great weekend. Aloha and goodbye, Southern California.